What up, what up, what up? This is Merrick representing Hustlenomics, LLC. This is the second episode of the podcast with my co-host, Terrence.
Yes, sir.
Today, we're going to be interviewing Efron and Lynn. They are two super successful apartment syndicators, and we're going to learn more about their story. So let's break into it. Guys, how did y'all get started investing in real estate? We want to know.
Man, first and foremost, Merrick, Terrence, thanks for y'all's time. Thanks for having us on the show. Really looking forward to this. It's been a long journey for us, but it's a good question to start off with. How do we get started off in real estate? Oh man, it started about 12 years ago. Right when I got out of school, I started working for this company called Rackspace. Met this guy. He was on my team. His name was Brian. I actually ended up living with him for a few years, and throughout hanging out with Brian and his family and whatnot, I started learning about real estate. His dad would always come over like randomly to get lunch with us or do dinners. And then one time Brian's like, hey, how about you go hang out with my parents at their house? I was like, dude, let's go for it, man. I'm always down for a family barbecue. And I go in there like, Mexican kid from a small town, go into this like big old huge house, like 5,000 square feet. I was like, what does this guy do? And I asked him, I was like, Mr. Dave, like, what do you do? And he's like, man, I do nothing. I just sit back and collect rent checks. And I was like, what do you mean sit back and collect rent checks? He's like, yeah, I was a general contractor for a long, long time, had my own business, and I started buying a bunch of rentals, and now I have like 10 plus rentals, and I just sit back and get rent checks. They're all paid for, and that allows me to just sit back and hang out with you guys. And then the light bulb went off, and I was like, what? Okay, well, let's do it. And he was like, yeah, Efron, Brian, don't spend all your money. At least buy a house or buy a couple of rental houses. And that's when it started. Like in 2012, I bought my first house in Austin, Texas. I house hacked that. I rented out all the rooms. I even rented out the couches to some of my fraternity brothers. Heck, one of my fraternity brothers started his business, on my couch. He would have people laying out on the couch. I was like, all right, time to go to work, right?
Hey,
and after that, yeah, go ahead.
That's exactly what I'm doing right now. I have a single family, and I'm bringing out every single bedroom in it. So great minds think alike.
Yeah, man. And that's how it worked for the longest time. Like I rented out that house to my friends for a couple of years. I bought another house in San Antonio, and then I was on a roll. I think I bought a house every year and a half. And before you know it, Lynn and I had 10 single family homes. And here we are right now.
That's awesome.
Yeah. It sounded like Rich Dad, Poor Dad. Like you actually lived it.
No, that's awesome.
Totally. We always talk about that.
Yeah. So what was the thought process behind all of that? Like it was just kind of organic, or did you find a pattern that you kind of like with, buying a house a year, or the strategy? How did it morph into, the syndication route?
It was another good question. It was more organic, like we had a few homes, believe it or not, we were renting it out. It was providing us grocery money, as I like to say. It was helping us pay our bills, paying vacations and what have you. I was still doing my W-2 job. Lynn was doing her W-2 job. And I think the catalyst for change that morphed into the multifamily is when my dad passed away a few years ago. My dad, smartest man that I know, highly intelligent, successful individual. He was an electrical mechanical engineer, worked until he was 69 at Dow Chemical. And then right before he turned 70, when he was supposed to retire, he passed away from COVID, and that was the point in my life when I realized, like, I can't work a W-2 job up until I'm 69 or 70. Heaven forbid there's another pandemic that happens and I catch something based off of my genetics and pass away and leave Lynn alone with the kids. And I said, there's got to be a better way to get out of this corporate rat race. So Lynn and I actually signed up for a single family home program about 2 years ago that taught us how to wholesale, how to flip, how to find off-market deals, how to Brrrr, basically, homes. And we started doing that, and we got up to 10. And then along the way, I was like, when 𝐤𝐺𝐻 came, I was like, all the pipes broke. I was like, oh, man, I'm not equipped to manage 10 properties. There's got to be an easier way. And one of our mentors from Rackspace, his name's 𝐦𝐤𝐤𝐿, he had started doing the multifamily syndication a few years back. And he said, Efron, whenever you and Lynn are ready, and you hit that point and come to that fork in the road where you realize, hey, I got to toss in the towel, give me a call. And that's what happened. Lynn had got let go from her job, and I'll let Lynn talk about it for a second, but that kind of actually paved the way for us to go into multifamily.
Yeah, no, it was we had a baby and then his dad passed away and I got let go and I thought, I actually froze up and I freaked out and I was like, maybe I should go find another job. But then ultimately we kept having these conversations like, hey, we can't keep repeating the same lifestyle. And the single family program really, really kind of launched that path for me to say, hey, I'm gonna bring in some revenue to cover my paycheck. And if I don't figure it out, I'll go back to work in a year. Well, we found out the single family program would not be able to, would not allow us to be able to offset both of our incomes. So we reached out and started bridging our connections with our previous executives from Rackspace, a company we both worked for, who were already doing multifamily successfully. I called up these guys. I asked them out to lunch and I said, look, this is where I'm at. Teach me the way. I know you guys are doing this and I've seen you guys going through the single family route. Tell me why and let me figure it out. And ultimately they were looking for somebody to basically run their program for them. They had an educational program that taught you actually how to syndicate. Programs called Apartment Educators. It teaches you everything end to end, what you need to know. But just know that the knowledge is about 20% of it. The 80% of it is the ecosystem and the network that they plug you into, so that in turn it gives you the ability to come onto deals at an entry level partner, and from there learn a little bit more, and it's a snowball effect until you can become a lead sponsor on one of your deals. So that's exactly where we're at. We've built some pretty amazing trusted relationships with people. We have a baseline of knowledge of understanding how the process works, and we're just amazed by how what you know and in combination with who you know has completely changed our trajectory and plans for our lives.
That's incredible. So basically, all you did was reach out, and because you reached out and put yourself around successful people, that just changed the trajectory of y'all's lives.
Exactly.
Well,
Exactly. And I mean, there's so much more to it. I mean, you meet a lot of people in this space that you would have never met before. And it's people that have a very, very similar goal and a very similar, financial plan that they want to change for their kids that they didn't have growing up. And it's all these people that are coming together to form these relationships and these partnerships and taking down multi-million-dollar dreams that you could have never even fathomed when you were going to college and saying, hey, I'm going to go and get like a high-paying W-2 job. So it's really been life-changing, to say the least. We're about to be in our fifth deal this year, so
congrats.
That's awesome.
Congrats.
it's going to
So,
be a fun ride.
so if y'all just stuck to the traditional route, what would y'all have been? Like I heard Lynn saying she got laid off. And Efron, where were you before?
I was doing tech sales at a company called Rackspace, and now I'm at another technology company called Salesforce, doing sales for them. And I'm still going down that path, but if I didn't find real estate, multifamily, single family, I'd probably be a manager, aspiring VP down the line. Like that's what I always told myself. I was like, hey, I want to be like a VP of sales or something, or maybe a chief revenue officer. That's where I thought I wanted to be. But then after all that stuff happened, I was like, I don't think I want to climb that ladder, that's going to take me 15, 20 years to get there. And then guess what? Like if they got to do layoffs and just say bye to me, then they'll bring somebody else in. Like, man, I just worked 20 years for a company and then I'm just a number at the end of the day.
Right. So
That's
yeah,
still a great path, by the way.
Yeah.
Just saying.
yeah, for some, but we had ambitions to have that freedom, man. And this is it.
Yes.
This is it. By investing, I always feel like at some point we have to get our money deployed and working for us. And I'm sure we all can agree real estate is one of those revenues for that. But I'm curious about that transition to multifamily and commercial. Like what was the transition from a mindset and financial standpoint? Of course, you had 10 homes plus a W-2. So what was that like? And if you don't want to talk about all the details of the numbers, but what was the high level of that process and making that jump?
Yeah, I think for us, like we were already doing the Burr model where we find undervalued assets in good locations, good school districts that just frankly haven't been taken care of. So we find those, we buy them, then we renovate them, we put new floors, new countertops, new fixtures, we paint them up, and then we rent them out for a premium and take all our money out. And then when we learned when our mentors were doing that just on a larger scale, like we felt like we already had a crew and almost like those battle scars, so to speak, that said, hey, let's try this out. And then we got the education. Lynn started working with that apartment educators team. I joined the program as well. And it's like, okay, they're basically doing what we did with the Burr model, just a larger scale. Let's just go do it. Let's take massive action. Let's apply our knowledge that we have from single family, what we've already learned from multifamily. Let's put a team together and let's go run. Like, and it's really a team sport. Like that's
Mhm.
what I really love about it. It's a team sport. I could partner up with you, Mark, Merrick, Terrence, the whole team over there. So that's what we really liked about it versus single family home. I felt like it was cutthroat, you know. I feel like I got to try and close this deal as quick as possible, you know, before the other person scoops up this property, you know. And then when you're trying to sell it or flip it and what have you, I just feel like it was super cutthroat versus the multifamily space. I feel like it's more of a true team effort, and it probably flows naturally with our skill set in the team that we work with today.
Can you tell us about y'all's first multifamily deal? Y'all closed on y'all's first apartment complex.
The first apartment complex, it was actually a passive investment. So it was based in San Antonio. It was with that apartment educators group. It was with Able. It was around 108 units. And this is a deal that we invested in passively. So with multifamily syndication, you could be a passive investor where I give somebody money, that person that I trust that is going to go put together a team, find an asset like an apartment complex and add value to it. So I could give money to somebody like to you, Merrick, and say, hey, I want to give you my money. You go do this. And I just want to collect quarterly payments and just sit back and chill. So that was our first investment. And after we had done a couple of those, we're like, you know what? I think it's time for us to jump in the seat, jump in the front passenger seat, you know, and partner up with these other folks. And we've done a few of those since as well, which it would be active, considered active.
Yeah. Do you consider any barriers to get into multifamily, such as like finances? For that first jump, have you seen? What have you seen in the market? Just curious for our viewers and listeners.
I would say there are some barriers. You got to have some capital. You got to bring some cash to play.
Mhm.
Same thing with single family homes. Like you got to put a down payment to buy the home. You got to put some cash down to renovate it. You got to find the contractors. Same similar thing. If you're going to be a passive investor, you got to bring 25 to 50 grand to the table.
Gotcha.
At a
Gotcha.
minimum. At least that's what we've seen.
Yeah, I seen.
Right.
Yeah, duo.
I know there's quarterly, there's monthly, quarterly, and annually distributions.
Mhm.
So
Mhm,
that's pretty nice.
mhm,
That's
mhm, mhm. Yeah, and as a passive investor, you get those checks. You know, it could pay for a nice dinner if you want to go to 𝐤𝐤𝐺𝐻's or Ruth Chris, what have you, Papados in Houston. You could do that as well.
Yeah, yeah. What was the next step after it? Like after you did your first deal, did it hook you? How what was the mindset from going and then now you're looking at it to where you're trying to do your own deals? Like what's the process and the trajectory like for that?
I would say it did hook us. You know, like we gave some money to the people that we know and we trust. They became our mentors. We signed up for the program. I did. Lynn was already part of it. We started learning the ropes, and then we started getting those quarterly payments. We're like, okay, this could pave the way for us to get out of the corporate rat race. Like, let me learn more. And
Mhm.
we joined another group as well. So like we joined 3 masterminds in total, and I would say they were 100% worth it because they've already paid for themselves
Now
just based
I'm
off
sure
of.
they weren't cheap. So that barrier of saying, hey, this upfront cost or the knowledge that's gonna, allow me to have the access.
Oh yeah.
Yeah,
W-
I'm pretty sure.
when you put that you when you pay for these mastermind programs, you are motivated and determined to get the return back
Right,
on that
right.
investment.
I bet you
And
are.
that's really, really key. And even whenever I talk to other people about joining different programs, I say, hey, if you're not dedicating time to this, because this will take time out of your day, and if you're paying up for this money for this program, $20,000 to $25,000, that's a lot of money. You
Yes.
better be motivated to get that back. And it's really in your court, right? It's just like a college degree. You pay for a college degree, and you still have to activate upon it once you upon completion. You got to put in the work. You got to find an internship. You got to find somebody that's going to take you in, and you got to climb that corporate ladder, and you learn a little bit more along the way.
Right. And that's kind of where you guys are now, to where, you know, it's the putting together the deals and doing all the underwriting to sense and fundraising. It's a lot of intricate parts within syndication. What roles do you play, or what roles do you see for others that you would like to have on your team to play a part in it?
Yeah, I'll let
I
Lynn
could
lead that
take
one.
that.
Yeah.
Yes. So on the general partnership team, there's multiple ways to get in. There's different avenues. There's different skill sets that are involved. You
Mhm.
figure out what your strengths are, and you complement them with other people that are stronger in other categories. It doesn't mean that you're any less strong in those categories, but maybe it's something you don't prefer doing. For us personally, because we both come from a tech sales background, we are natural capital raisers. So we didn't know that, but people had already told us, hey, this is probably the route that you should try taking. So we took an entry level approach to it. We came on as an entry level. We said, hey, like, I'm not sure how much we can raise, but we can exercise it and see, but I don't want you to commit to me saying I'm going to be able to raise $1 million. And it's about having the right conversations with the right investors. And we both have a different way of communicating it dependent on who our peer groups are. And then from there, it's off to the races. Now we're in multiple deals where, hey, we're learning other aspects of the business more, like the asset management side. So if you're good with Excel and finding and doing deals and running numbers on Excel sheets, finding a deal could be your sweet spot. That could be your strength. That could be your way in. Everyone's constantly looking for deals, and it's hard to find. So if you're really good with numbers, that could be your avenue. Other than that, I would say there's other ways to get in. You could be, you could be the person that brings the pursuit or earnest capital. You could be a key principal if you just have, a really high net worth. All of these things that all come in together, and there's multiple ways to get into a deal. So don't think that the money aspect is a limiter.
So you said a couple of terms that some of my viewers might be confused about. You said principal distributions, and capital. Can you please elaborate on those terms just so that everyone knows
Yeah,
what we're talking about?
definitely. So when you're putting together a deal and you find a deal, let's say it's maybe a $10 million deal. A $10 million deal, generally you would have a loan just like a house, right? So a loan would include maybe a leverage of about 70%. So maybe the bank might give you 70% for this $10 million loan. So the remainder is what you got to bring to the table, which is around $3 million, right? Nobody has $3 million in the bank, right? So what you do is you put together a team that can basically raise capital for that portion in addition to other responsibilities, such as putting together the investor deck, such as doing due diligence on the property, things like that. And then what was the other one? The key principal. So a key principal is somebody that basically signs on the loan, but in order for a lender to approve you, you have to have particular parameters in place, such as a net worth on paper of the amount of the loan plus 10% liquidity in the bank. So you got to find that person. But usually when you join some of these programs, somebody will already be a solid key principal. And if they know you and they trust you and they know that you can operate because, hey, you've already done the course, you got the education, they'll sign on that loan for you just to get a piece of that equity.
Oh,
They call it the rich person tax.
That makes sense. Yeah.
But yes, there's multiple ways to get in, and ultimately you figure out what you're missing on your team, and you fill the gaps.
All the time. Yeah. Any thoughts about the current market, and then maybe you can dive into some of your deals, unless you have some other questions. Any thoughts about the market?
well, I want to say, what are distributions, just for people who might not know?
And then let's go into that.
All right.
Oh, yeah. Distributions. Distributions are payments. Payments for cash on cash returns. So for instance, let's say if you are a passive investor and you put in, I'm going to use whole numbers just to keep it easy. If you put in $100,000, you'll get, usually what happens is there's projected returns, and usually there's a baked in preferred return. The preferred return is generally what you'll get annually cash on cash back in your pocket. So 7% of 100 grand, that's 7 grand that you'll get annually until the property closes. And ultimately, you'll get a cumulative amount at the end when the property sells that's going to equate to the equity multiple. So
What's
I don't
equity?
want to say it's a solid 7% because it fluctuates, an average of.
Can you explain what equity multiple is?
Sure. In most cases, if you are a standard stock investor, right, annually you'll get back maybe 10-12%. Is that on average, right?
Right.
From
Like
the standard stock
At
market.
least used to be. In the past couple years,
I,
no.
I wish.
Used to be.
Where are you getting
right?
10-12%? Let me see that.
Not recently, that's for
What
sure.
portfolio do you have?
No, I'm not looking hot either.
That's why I'm doing real estate.
Right. So in multifamily, generally what happens is when you find a deal, you go under contract and you basically say, hey, to your investor group, hey, we found a deal, let's run a webinar. A webinar will actually highlight all the property features, and including the location, the demographics, everything related to that property that might be a value add to why, hey, this is a justifiable asset to invest in. So one of those key criteria that you cover in that webinar is the equity multiple. So the equity multiple might be anywhere from 1.5, 1.6, 1.7, 1.8, 1.9. Sometimes the market's not great and you could say, hey, we're projecting a 1.5 or 1.6. And what that means is, let's say if you put in 100K, the ultimate forecasted goal with this conservative underwriting model that you're expecting is that you'll get 1.5 or 1.6 or 1.8 back of what you put in. So 100 grand could become 150, 160, 170, 180 at the end of the project.
And that's typically over like a 5-year period, or what do you
It's
see?
generally a 5-year hold. However, depending on the market, usually properties could sell at 3 to 4 years. But we don't want to, make any sort of assumptions. We want to make sure that we're conservatively forecasting for the full 5 years. You never know what's going to happen. You never know if, another pandemic that's unpredictable is going to strike, and we might have to hold the property for longer.
Right.
And that's the best part about real estate, because you can hold and ride it out, right? And you're still banking on appreciation at the end of the day.
Yes. That's the beauty. You got equity and you got cash flow.
Cash flow's the best part, man.
Yeah.
Cash flow's the best part.
It is. I like the equities, but that's what
I like them both, right? That's the
Yeah, I
they
mean,
always preach
you put
cash
them
flow.
together, it's a sweet deal.
It
Yeah.
is.
Yeah. Go ahead.
I was gonna add on to that. I guess I've been having other conversations around the cash flow aspect with people that are already doing single family and doing multifamily. And I think there's a conflict between whether you sell all your single family and go all in on multifamily, or you dabble in both for some time period until it makes sense to completely go. Personally, I feel like because we're still learning and we're still, we're still kind of like working with, really experienced people, and we're still kind of evolving and seeing what's going to happen down the years and things like that. And we haven't actually exited like our first deal yet. It makes sense for us to hold on to our single family portfolio, because that's what really provides us with the cash flow. In the multifamily space, there's only two big times when, as a general partner, that you really get paid, right, Efron? And it's really just passive cash on cash, the preferred from the limited partner investment, because usually you invest into your own deals. And then it's at the exit and maybe a little bit at the beginning for the acquisition fee, right?
So you don't get monthly distributions if you're a general partner?
It depends on each deal. The way ours are structured is quarterly, but those
Okay.
don't kick in until after like 6 to 9 months, because in those first 6 to 9 months, that's when you're basically turning the property around, doing a lot of your heavy CapEx, doing a lot of the renovations on the exterior, then slowly increasing rent. So then in turn you change your net operating income, and then you can have those distributions. But yeah, typically what we do is it's quarterly. There are some that we're part of that are monthly, but it's all dependent on the team and how they structure the deal.
Right.
And the bottom line number in multifamily, is it cap rate? And what's the metric for knowing if a property has appreciated to the level that it's time to sell?
Oh,
I'll let
What's
you field that one, Lynn.
Yeah, what's the exit?
I think you always underwrite for a higher cap rate, right? I'm not really the big the underwriter of our group. I think that would be Efron, but I would say yes. The baseline is, hey, finding deals that make sense from a numbers aspect. Maybe
Right.
really trusting your underwriters of that deal, having it underwritten multiple ways and multiple times and stressing it to the max, so that in turn, if worst case scenario happens, like you're still going to be able to reach those returns for your investors.
Okay.
Right. So it's interest rates, it's cap rates. There's a lot that goes into an Excel spreadsheet. These performers are
Yeah, we
very,
could have
very,
a whole
very,
other hour conversation around that
very
stuff.
complex. But ultimately, just know that these teams are really stress testing all of the numbers to the nth degree, so that in turn, if something goes completely awry, it's covered for.
So I gotta ask y'all, where do y'all see yourselves in 10 years? So y'all knocked out 50 deals. What's
10 years. I'm watching our oldest, London, who's 11, probably graduating college by then, because she'll be, 20, 21. She's super smart. We'll see the other one, Hayden, graduating from high school, and then I'll be coaching little baby Coraline in volleyball or soccer, and I'm just chilling, collecting those paychecks like Ryan's dad, David, just hanging out, barbecuing in the backyard, drinking some tequila every now and then. That's what I want,
Yeah, I mean, for me, the whole reason why we're doing this is to get flexibility and control over time back in our lives, right? We've been all grinding since we were in kindergarten for a particular lifestyle, and to work for, corporate America, and to fill our days with 40-hour work weeks so that we can bring a check home and put groceries on the table and maybe afford, a single family vacation per year. My thought process is, hey, getting time back to do whatever I need to at that time, and being there for people that need us to be there, and to spend time with people that, are meaningful in our lives. And that's really the motivator is, hey, if my daughter needs me to be there at a volleyball game on a weird Saturday in a random month, like, hey, I can show up and be there and not have to ask, somebody else to be like, hey, can you take my daughter with you? I'm not going to be able to go there because I have a work event that I have to tend to. Things like that, I guess thinking back about Efron's dad, it's like, I wish we had more time with him, and it was like, he just moved to the house next door. Like, why didn't we get to take more trips with him? Things like that.
Understood.
Life is short.
Yeah.
So do what you want to with it, not what people have told you for many years.
I can agree.
Last question to conclude this interview. Guys, I want to know, hey, I want people to be able to get in contact with y'all. So what's the name of y'all's business? Just go ahead and let the viewers know.
And then also, I'm curious though, if you got any deals or people can connect with y'all, and you can give them a little elevator pitch, feel free to do that as well.
Yeah, all good questions. Our company's called Luna Capital Group. It's named after the house that I first bought that I was house hacking back in 2012. It was on Luna Street. So that's what we named it, Luna Capital Group. I got my little thing right here. And then you could connect with us on Instagram, Luna Capital Group, GRP, or our website, which is lunacapitalgrp.com, Luna Capital Group. We'll
Yes,
sign up
and
for our newsletter.
yeah, sign up for the newsletter. We are so stoked about meeting new people, just talking about real estate, just connecting in any way possible. Phone call, text, email us. We'll meet people out if they're local. We're also, traveling back and forth from Houston a lot. So if anybody wants to meet up and just have some coffee or lunch, we're more than happy to just share knowledge and see how we can connect and help out.
Let me know when y'all get back in town.
Yeah, for
Definitely.
sure.
Any deals opening right now or
About to be. We are about to announce something coming up. So can't share too many details about it, but there is something in the pipeline coming in the next couple weeks.
Awesome.
Yeah, and if
So
there's
sign
anybody
up for
that's
the
listening,
newsletter.
yeah, if there's anybody that's listening to this and you guys want to get in contact with us, you sign up for the newsletter, shoot us an email. I'm always happy to chat with people to walk them through what we've been through, whether it's single family, multifamily, fix and flips, you name it. I think it's my time just to give back. So always happy to chat with people and give back to the community.